Ladies and gentlemen, good day and welcome to GHCL Textiles Limited Q3 FY24 earnings conference call hosted by Go India Advisors. As a reminder, all participant lines will be in the listen-only mode and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Ms. Sheetal Khandoja from Go India Advisors. Thank you and over to you.
Aditya, good evening everyone. A warm welcome to everyone attending the GHCL Textiles Limited Q3 and 9 months FY24 earnings conference call. This is the maiden call for GHCL Textiles. We have with us on the call today Mr. R.S. Jalan, Non-Executive Director, and other members from the senior management team. The discussion today may include certain forward-looking statements and may be therefore viewed in conjunction with the risks the company faces. I shall now hand over the call to Mr. Jalan for his opening remarks. Thank you and over to you, sir.
Thank you, Sheetal. Thank you very much. Good afternoon, everyone, ladies and gentlemen. We are pleased to welcome you all to our Q3 and 9 months FY24 earnings Concall. Our investors' presentation has been uploaded on the exchange, and we hope you have had the opportunity to review it. This is our first ever investor call for GHCL Textiles Limited, and I am accompanied by Raman Chopra, Non-Executive Director, and the management team led by Mr. R. Balakrishnan, CEO, Mr. N. Rajagopalan, Head of Technical, and Mr. Gaurav, CFO. In the interest of some of the people who are new to the company, let me first start by giving a brief introduction and overview of the company, followed by the strategic updates and performance highlights. GHCL acquired Sri Meenakshi Mill in the year 2001, and the business has been turned around from a loss making 65,000 spindles to a new profitable business equipped with the state-of-art manufacturing with 225,000 spindles and 62 megawatts of renewable assets. In the last 20 years, we have achieved a 15% CAGR revenue growth and the EBITDA of 31% CAGR growth. Our average EBITDA margin for last 5 years is 17%. The spinning business has been demerged into GHCL Textiles Limited and is listed on both National Stock Exchange and the Bombay Stock Exchange since June 12, 2023. This demerger was done with the objective to simplify the corporate structure, facilitate independent growth path, and maximize shareholders' value. Today, GHCL Textiles is a prominent yarn manufacturer known for its high-quality product. Our philosophy is to manufacture premium products, including high-quality yarn. At the core of our strength is the ability to deliver customized value-added products that cater to the unique requirements of our customers. With a dedicated workforce of 3,150 employees, among whom 80% are the trained and committed women, we emphasize our commitment to community involvement, a significant factor contributing to our success. Moving into the business scenario. Cotton prices are now stable in the domestic market as well as in the New York futures. Overall, yarn market seems to be improving now, and the domestic market demand is better in the value-added counts and the imported cotton yarn segment. In the Europe and US market, there are signs of improvement after the festive season. In the near term, our outlook as the cotton prices are more stable, we expect the demand to recover gradually. Spreads should improve and downside seems to be limited. Our performance, our Q3 FY24 revenue from operations showed a year-on-year increase of 5.7%, reaching to 246 crore with a 54% coming from a value-added product. EBITDA for 9 months FY24 came in at rupees 60 crore as compared to 70 crore for full year 2023. Overall, our plants are operating at 98% capacity utilization plus 98% plus capacity utilization. Balance sheet remains healthy at 2 crore net debt in books, which offers ample room for growth. GHCL Textile Division's vision is new investment under MOU we have signed with the Tamil Nadu government with around 1,035 crore investment. Out of that, 360 crore has already been invested as on 31st March 2023. This investment propels our initiative for expanding capacity, diversifying our product range, vertically integrating textile manufacturing to include knitted and woven finished fabric. We will augment our green energy portfolio to 75 megawatts from the current 62 megawatts, thereby enhancing both cost benefit and sustainability. We also plan to gradually increase the spindle by around 1.5 times. Our vision is to double our revenue in the next 3 to 5 years and maintain an average of 18 to 20% EBITDA margin. Thank you. We can now open the floor for Q&A.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Our first question is from the line of Jalja from Swan Investment. Please go ahead.
Thank you, sir, for an opportunity. Sir, as you indicate that the spreads are improving and there's a limited downside, so can you help us understand what was the spreads in the last quarter and what are the spreads right now?
See, basically, as I mentioned to you, in terms of the number which I have given you, the EBITDA margin in this quarter, which is Q3, is around 8%, 8.2% to be precise. And our expectation in the fourth quarter, it should range around 10 to 12% kind of a number. And I think 24, 25, my belief is that this number should come back to the normal of around 15 to 17%.
So, sir, this is, what will drive? Is it just a spreads or we are improving and efficiencies also, or some product level efficiencies that we are doing it, which will help us in improving this margin?
Basically, the major portion of this will be from the market outlook and the cost of raw material, which is the cotton, because now the cotton prices, as I mentioned, is stable, and we believe that the cotton prices should be in the range bound, and the market demand will improve. And particularly the value-added segment which we are focusing on, there also we are seeing a demand traction is happening. So this all will help you. And in terms of the efficiency, that's a continuous process. Like I said, my utilizations are already 80, 98 plus, or maybe in some units it is 99 plus. So I don't see major benefit coming in. Of course, some benefit of your energy, because in the last year, or current year, in the last second quarter, we have made some green energy investment which has started getting the benefit. So probably that will also get annual benefit next year. All put together, I think this benefit or next year of the outlook which I am talking about.
And sir, in terms of the expansion that you have taken, because you already invested 360 crores in Tamil Nadu, we will be increasing the spindle by 40,000 in 2 phases. So by when this facility will come, and what will be the incremental contribution from these new spindles?
You see, this 40,000 spindle has already come into the and this is operating fully right now, and obviously that will help us to kind of have a bigger revenue, as well as next year 24-25 you will get the full benefit of this revenue as well as the margin, EBITDA margin add on to that.
So can you quantify in terms of
we are also adding another 25,000 spindle, which will the work has started, and that will come on stream by March 25. The benefit of that will come in 25-26.
So, sir, incremental revenue contribution, can you help us in by what can be the incremental revenue contribution from the 25,000 spindles that can come in FY26?
Broadly, roughly around 250 crore kind of a revenue will come in from that.
Okay, sir. Thank you, sir. That's all from my side. I'll come back in a queue if I have more questions. Thank you.
Thank you.
Thank you. Ladies and gentlemen, a reminder to all participants, you may press star and one to ask question. Our next question is from the line of Masjid Ahmed from Smart Singh Investment Advisor. Please go ahead.
Yeah, thanks for the opportunity. Firstly, how is the export revenues looking like and going forward? Do we anticipate a larger pie of revenues coming from exports? Any ballpark numbers that you can guide? That's the first question that I have. And secondly, on the capacity expansion, we are moving to value-added products, higher margin products. How much incremental revenue is expected to add once the capacity expansion is done? And what will be the revenue mix looking forward for value-added products and other products? Thank you.
Yeah, basically, if you look at in terms of our export footprint, which was in the range of around 6%, moved in the 9 months, it is around 14%. And gradually, our belief is that the next year we should be hitting a target of around 20%. So gradually, we are increasing our footprint on the export. The second question which you spoke about, the new investment. Sorry, if you could repeat your question, second question.
Yeah. So the second question, you are moving to value-added products. How much incremental revenue is it expected when the capacity expansion is done? That is the first part of the second question. And secondly, what is the revenue mix they are looking for value-added and other products? Can you give that clarification or mix?
Yeah. So if you look at in terms of our revenue growth, which is approximately this year will be likely to be around 1,000 crores. This should move next year around 13 to 1,400 crores kind of a revenue should come in from and the second, what you said about the revenue from the new investment which we are talking about, next year our revenue will be something around 1,300 to 1,400 crores.
Yeah, that's fine, but I'm saying the revenue mix for value-added products and other products. Yeah.
So I think that number we have, I think, is around 52% or 56% is 54% is a value-added product. And probably I would say that this should be in the same range bound of 54-55% kind of a range bound for the next year as well.
What's the margin that you're expecting value-added products going forward?
See, margin generally in the value-added product, when we talk about the value-added product, I'm talking about the specialized yarn. Let me be very clear on that. The margin is spread between the commodity and the value-added segment. There are two important differentiations. One, in the value-added segment, the fluctuation in the market or the beating on the because of the market condition gets reduced. That means your stability of margin will be visible on that. That's number one. And the second will be your advantage of margin will be something around 2 to 5% kind of, depending on what kind of a product, 2 to 5% extra margin you should be getting on that product.
Okay. Thank you. All the very best.
Thank you. Our next question is from the line of Sarvesh Gupta from MX Capital. Please go ahead.
Good evening, sir. Just to understand, so this quarter, this increased 40,000 spindle is already there in this quarter, and we are doing around 250 crores, right? So then how are we expecting 1,300 to 1,400 crore in the next financial year?
As you rightly said, if you look at in terms of our total, if you look at 22-23, you will find our revenue was in the range of around 900 to 1,000 crores. Okay. And this drop which has happened is primarily in spite of this new 40,000 spindle coming in spite of that this year's revenue. That means there was a significant drop in the per unit sale price, right? So that's the one thing which will, our expectation is that the selling prices will improve because I said the rate will increase. So that's number one. Second, the full utilization of this 40,000 spindle And another two investment which we made in some of the in the other two units of making our product volume higher in two other units, that has just completed in December. So the benefit of that will also coming in the next year full quarter, full year. All put together, based on this, our expectation is around 1,300 crores of investment will come in.
So, sir, 225 was the earlier one. 225 got increased to 265, which is like 17-18% growth. So, what we are saying, because of other measures, we are expecting more than 30-40% growth in spite of the capacity going up by 17-18%. Is that the right understanding, sir?
No, basically, I'm giving a 9-month period or the 12-month period of last year. Okay, that's a consolidated number, which is 1,037 crore last year. FY22-23, 1,055, sorry, 1,037, okay, to be precise. Okay. This year we are expecting this number to be on the same level of 1,055, almost same level. Okay. Now, basically what we are saying is there are three changes which will happen. On one side, this two new investments which we have made. That's the one investment which will give you benefit, number one. Number two, this benefit of this 40,000 spindle, which will get fully utilized, which was not there in the whole 9 months. That is number two. Number three, we are expecting that the revenue will increase because of the per kilo sales realization will also improve. I'm simply giving the math. In last year, in 22-23, my revenue was 1,000 crore. After that, we have added 40,000 spindles. By all means, this 40,000 spindles should have given me 300 crores of top line. Right? So this put together, our estimation is next year it will be 1,300 crores.
Understood, sir. And
Hello, sir.
then
Sorry to interrupt, sir.
correct. Hello.
Hello, sorry to interrupt, sir. There are many people in the queue.
Yeah, just one more, just to finalize this conversation. So this I understood, sir. What is the working capital cycle for this business, and what will you expect next year?
You see, generally the working capital cycle is around 130 to 140 days in this business, generally, okay. But depending upon some time of the market, this 10 days here and there, and again, seasonality also very important. Because when you see in the month of December, probably the working cycle will be slightly higher because you buy the cotton, which is a very major raw material of your thing. Your number of days are higher. But if you look at in the month of June, probably you'll find the number of days cycles are less. But generally, you can assume 120 to 140 days kind of a business cycle in this.
And depreciation should remain the same because now we have already done all the investments for this 265.
Yes, this quarter the depreciation will remain the same.
Understood, sir. Thank you and all the best.
Thank you. Our next question is from the line of Dipesh Agrawal from UTI AMC. Please go ahead.
Yeah, good evening, gentlemen. My first question is a clarification. When this 40,000 spindle got operationalized, was it the end of December?
No, this had got, I think, in the month of October, got commissioned.
Okay, so the utilization number which you are sharing at 98%, this is X of this 40,000 spindles or even that is included here?
That is also included in that. And you see, basically, what this 98% when I'm talking about this, I'm talking about in all the units because we have a separate unit for the. I think we have 5 units. Okay, so almost somewhere it is 99%, somewhere it is 98%. So in all the units put together, or I would say even if you look at separately, also you'll find that in all the units it will be 98 plus utilization. In some cases it will be even 99% also. So we are fully utilizing the assets.
Understood. And I think you also have a fabric revenue. So what would be the fabric capacity currently, fabric revenue and expansion plan out there?
You see, fabric, we are right now not very significantly placed there. What we are doing is we are doing the kind of we are doing outside fabric conversion. and we are exporting that fabric. And this purpose of this is doing it to understand the market and kind of ultimately, like I said in the opening remarks, to ultimately penetrate or make our own manufacturing of fabric, including the knitting and weaving both. Currently we are doing, but we have a plan to make an investment or make our own unit for that.
Okay. And this would be a grey fabric. There is no processing involved right now.
Yeah, it will go. We will go gradually on first we'll go for the grey fabric of weaving and knitting. Then ultimately we are planning for going for it process fabric also, maybe later on that.
Okay. Any plans so far framed up there on the expansion on the capacity there?
Sorry, can you repeat? I'm not understood. Voice is little.
So can you share more insights on your fabric expansion plan?
I'm not understood your question. Honestly, can you slightly away from the from your speaker, and because your voice is slightly not very clear. Can you repeat the question again, please?
Yeah. So my question is, can you throw some more light on how do you plan to build a fabric capacity, by when, what could be the size of capacity, any plans yet?
This, I think, we are in the, like I said, we are in the phase of studying this market, and probably this will happen in 25-26, because currently at this year 24-25, we will be making this 25,000 spindle investment, and based on our experience of this 25-26, our aggressive plan will be more, instead of going for the spinning side, we will go for a weaving and knitting investment.
Understood. Sir, what is your inventory holding policy for cotton?
You see, basically it's a very dynamic decision, honestly. It's a very dynamic decision. Because we have a deep-rooted expertise, if I can use the right word, of understanding the market, and we do a very detailed evaluation on a day-to-day basis, and to understand the sentiments of the market, and based on that we make a decision. But generally, I would say that policy, or in a way, I would say the preference always is that we try to build the inventory if we believe that the prices are going to be stable. We try to bring the cotton because of the quality. Say around 80% of the total requirement of the year by March. Like this year, if you look at, our plan is to cover 80% of the cotton by March, because the season starts from 1st of November, and for up to 31st of October, 12 months, 80% we will be covering by March 24. And balance 20% we will be covering over a period of time. So that's where right now this year's plan is. But last year was slightly different, depending, because we believe that last year the availability of the cotton in the market, and we became right on that. The availability of the cotton will be there because the crop size we could estimate. We have seen that the farmers are holding the cotton, and ultimately those cotton will come and the quality will not be an issue. Therefore, last year the figure was much lower. So depending upon how the market scenario is, we try to cover the cotton.
Sure. And lastly, sir, if you can share what would be the capex for the current year and capex estimate for the next year?
See, next year our major investment will be only this 25,000 spindle, which is roughly around 200 crores. And this year, I think we have already made an investment of something around 66 crores, and maybe another 10 crore, 15 crore kind of a number will be coming in.
Sure. And maintenance capex would be another 30-40 crores?
Maintenance expenditures are not part of this. Maintenance expenditure always gets charged to the profit and loss account.
Sorry, can you repeat?
Maintenance cost we always built into the operating profit, and we never kind of capitalize that maintenance cost.
Okay, understood. Thank you, and all the best.
Thank you. Our next question is from the line of Saket Kapoor from Kapoor Company. Please go ahead.
Namaskar, Jalanji and the team, and thank you for this opportunity, and thank you for engaging with investors in the middle Concall. Congratulations to the entire team. Sir, firstly, if we look at our current margins, the current margins are outcome of the inventory losses, and this is only what is going to get normalized with the current cotton season. This should be the basic understanding.
I would say that, yes, to some extent, inventory of cotton which might have been procured, particularly the imported cotton, some elements will be there, but that's not 100% of that element. Some elements definitely will be there. The second, we are definitely expecting that the spread or the margin will improve because of the improvement into the yarn prices. Because these are the rock bottom prices. And since the cost is now more or less stable, so we believe that the yarn prices will improve. That will improve our margins. And quarter by quarter, the improvement will be visible.
Sir, when you say improvement is...
March quarter, we will find that the margins are better than last quarter. That's way it will happen.
Okay. Sir, can you throw some more light on the trajectory, how the yarn prices and the spreads have behaved over the last 3 sequential quarters, sir? The June, September and December quarter, just to get an understanding how well the margins are now turning up the up curve.
I think, Sakesh, if you look at the number, you will find that, I think we have given that in the investor presentation which we have uploaded.
Okay,
you will
sir.
see that till June 22, I think margin was on a peak. Okay? Subsequently, the margin started getting deteriorated. And ultimately, till, I would say, last quarter, which is Q2, our margin was in Q2 was almost same level of 8.3%, right? Same level of 8, like what we did there, right? So that means the stability started coming in from Q2 24, right? There's some element of cost, some element of pricing, all those things will be combination will be there. If you look at in FY23, my margin was 6.8%. EBITDA margin was only 6.8%. And that was primarily got impacted severely into the third and fourth quarter. Earlier it was very good. In Q3, FY23 was only 1.4%. So at the same quarter last year, the margin was only 1.4%. I hope I've been able to answer your question. That's the way we are looking at. And maybe next quarter, if everything goes well, probably the margin will be better than this 8.2%.
Okay. And sir, what have been our investment in the renewable segment, especially in terms of the captive power investment we have done? And then, sir, for the line item, power, fuel and water expenses, does this consume only the coal and the electricity charges that gets factored in? I mean, if you could explain.
No, two things. One is that in terms of, like I said in my opening remarks, we have approximately around 62 megawatts of green footprint, which takes care of 72% of our requirement. Right? And that has a huge advantage in terms of both, in terms of the sustainability and in terms of our cost, freezing the cost, let's put that way. Okay. And the second, like you said, line item wise, we don't use any power here, any coal here. It is only the power, which is electricity, and we even buy some power from outside also. But the electricity board we are almost buying negligible. So we buy from third party. Even we buy the green power also from third party. Okay. And last thing, this year, the TLEP has increased the prices, and because of that, the buying which we have done is on the higher side. And because of that, cost is slightly higher compared to the same sequential quarter of Q2 FY24.
Oh, okay. And the captive percentage is, sir, how much, sir, of the total power requirement?
I said 72%. Of course,
72%. Sorry. Yeah. And further investment also we have outlined, sir, for this in the renewable segment?
Yeah. Like I said, again, my opening remark, our target is around 85% kind of a power. Of course, we have to look at, because in this slightly technical side, we have to look at the zone-wise also. There are different zones. In the peak period, the rates are different. And we have to utilize those in a rightful manner Otherwise, investment will not give me a return. At this point of time, at least in next 2 years, we are not visualizing any green investment for the time being. But once this this investment of 25,000 spindle gets commissioned, probably we will put two things. One is the rooftop, because rooftop we are really utilizing well. So we are because in all our factories on the rooftop we have a solar. So once that project is completed in 24-25, in 25-26 we will go for a rooftop, and depending upon its requirement and like the economics which I said, 25-26 probably we will make some investment into the renewable energy as well.
And last point was about the selling pattern, sir. How are our selling based on the contract basis, quarterly, annual contracts, or are they spot market sales? We have mentioned names of lot of market clients. So how do we just if you could explain to us the selling process?
Yeah, Saketji, I would like to say two things here. One is that there are the customers which I have mentioned there. They are all kind of a strategic customers. Okay. And when say strategic customer, where they have a specific requirement, a specific need of the quality, and we understand the quality needs because every customer has a different need. Okay, so we are kind of building that portfolio based on the customer's need of a particular variety or particular type of quality. So that we call this a strategic customer. Number two, these contracts are generally on a transaction to transaction basis. Suppose they have a requirement of 100 tons because they got order for something and they want 100 tons. So they will book 100 tons of quantity. That may be delivered in 2 months, or that may be delivered in 1 month, or that may be delivered in 3 months. Here it is not like that. Okay, you are booked for a year, or booked for 6 months, or booked for 3 months. That doesn't happen. It always happens quantity, specific quantity, and that gets delivered maybe in 2 months or 3 months maximum.
Right, sir. So we get a visibility on a quarterly basis on what kind of deliverables are, and that gives us the confidence that we are running on 98 or almost at full utilization levels.
No, I would not say that because of that we get a visibility, because there are many of the volume. It is not that, okay, in the month of December, I am very clear that what I will be producing in the month of January, February, March. No, we don't have that. Because product gets produced also and sold also. But we typically know these are the counts which are the requirement of the customers. We typically know that these are the volume which the customer will say. Second is, many of the counts which are not used by only one customer, that is being used by the many customers. Okay, so we produce and sell on those quantities, like which is you can say in a very high quality commodity product. I hope I'm clear.
So just a small point. So we have repeat customers in the entire ecosystem, and then we also look out for new customer addition. Just to understand this, since you are very confident about going ahead, what kind of revenue trajectory you are looking. So in that case, you are also very confident where is this going to be sold to. That was the reason. So we have a repeat set of customers to whom there is a dedicated setup wherein we know their requirement and we prepare according to that. This is a better understanding?
Let me clarify this. When I say, and historically we have been using this 98-99% utilization. Historically, it's not that the last quarter we have done, and year before it was 94%. No. So we run this 98-99% consistently. Right? Now coming back, like you rightly said, we have a visibility that what customers are looking for to be sold. Though we may not have sold it, but their annual or their monthly requirements are that time. And they always take their product on a month-to-month basis. I hope I'm clear. That is number one.
Yes.
Second, sometimes we get an order in advance also, which is very specialized in nature. Okay? And then we get a visibility of at least for 3 months or 2 months or 3 months of time, or with a particular count.
Mm-hmm. Correct.
It's a very stable business. It is not that, okay, depending upon the demand, the supply situation, if you are in a premium product, selling is not I would not say that that if the market is slightly down, therefore your utilization has to go down. That will not happen.
Correct, sir. And lastly, sir, on inorganic growth.
Sir.
Yeah, I joined the queue. Yeah. Sir, no issue. Thank you, sir, and all the best.
Our next question is from the line of Naitik from Squinting Investment. Please go ahead.
Hi, this is Naitik from Sequent Investments, actually. Yeah, so my question was regarding the EBITDA margin guidance that was given earlier on the call. So we are planning for a margin expansion towards 10 to 12% in quarter 4, and then probably 15-16% in FY25. So what would be the level that you think would come into picture for this margin expansion? Are we thinking the realizations are really going to go up for yarn right now, or is the impact of lower cotton prices is something that we are accounting for? Anything regarding that would be great.
Yeah, Naitik, let me give you my understanding about this business. Because we are in this business for a long years, okay? Please understand one thing in this business, the volatility will be there. And so that volatility will be visible. Like you have seen that in 22, our margin was 27%. Okay. Whereas 23, margin has gone down to 7%. So that kind of a volatility was there. So neither 27% is realistic nor 7% is realistic. Right? So therefore, what we always say is in a medium term to longer term, like if you look at our margin for last 10 years, you look at our margin, average margin of last 5 years, you will find that the margins are around in the range of around 17%, 16 to 17%. Right? And based on the understanding, like I just said, already more than a year or more than a year and a half, the market was subdued. And therefore, we are expecting this margin will come back to the normal level in 25-26, which is 17%. Huh? 24.
Yes, sir, I understand. Yes, sir, I understand that. I was just expecting if you could give some guidance on be it on the sales side or be it on the lower cost of raw material side, what was exactly that we were looking for? Or is it just that we expect the margins to return to the mean in a given period of time?
Let me give you one very unique thing in this. See, in this, the most important thing which we monitor is the spread. You see, cotton price, like I said already, cotton prices are more or less stable, right? Cost also, if you look at my power cost, you will look at my labor cost. My labor cost is minimal. Okay? So the better this margin expansion which I am talking about is more on selling price going up and cost, because the cotton prices are stable, cost, and like someone very rightly asked, some high level of high cost of inventory that will get settled. All put together, this spread will be, even when we prepare our annual budget, we don't prepare on the basis of selling price and on the basis of cost. We prepare what is the spread which we are likely to get. Of course, in that backward working we do with your cotton prices, but our benchmark of study and the performance is more on what is the spread we are going to get. And that spread, I said, 17%. Is a medium to long term, 17 to 20%. Now our target is 20%, and hopefully in next year, 24-25, it should be in the range of around 15 to 17%. We believe that we will be in a position to achieve.
Okay, sir. Thank you.
Thank you. Our next question is from the line of Prerna Junjunwala from Elara Capital. Please go ahead.
Hello, sir. Thank you for the opportunity. I have joined the conference a little late, so pardon if the questions are repetitive. I just wanted to understand the demand scenario. How is it panning out for Q4 and going forward, especially from your long-term margin perspective? By when do we see they being achieved, if the scenario continues to improve the way it is right now?
See, Prerna, like you rightly said, in terms of the Q4 looks to be better than Q3, and we personally believe that 24-25 should be coming back almost to the normal level. That is what our guidance for this business we are seeing. Of course, as you know, that the market or geopolitical systems are so volatile, probably talking with a certainty will be difficult. But this is what, and the regions are very clear. Let me tell you, three regions. Which one is cotton prices are almost Indian cotton prices are almost at the rock bottom because these are at the level of a support price for the government. Number one. Number two, destocking in the global market has already happened, and therefore there is a good opportunity and particularly I'm talking about the spinning perspective. Destocking has happened because the market was falling, and people were of the belief that further market will go down, and therefore almost like kind of the system was completely, pipeline was almost like empty. So, and now the demand of the final product, look at the home textile, look at the garments, are looking up. So we clearly see that demand will look up, and once demand look up, automatically margin expansion will take place. Third, probably as I said, this year cotton outlook, it looks to be stable. For the other side, and that's the reason some other investors have asked me, where I said 80% of the cotton we are covering. Probably there is a likely chance that in the later part of this year, maybe June onwards, the prices of cotton may firm up. And we are preparing ourselves to cover that cotton well in advance with the quality and everything. So that will also kind of help us to kind of everything. So broadly, our confidence level are based on these three parameters.
Okay. And how's the supply in the yarn market with respect to capacity, utilization, and where do you see where it was last quarter, Indian versus global?
Yes, Prerna, we are utilizing our assets 100%. Okay. Just mentioned in prior discussion, all the assets are fully utilized. Okay. And even I would say that the competition also, barring maybe marginal players, everyone is utilizing their assets fully, because that buoyancy everybody is seeing in this industry. So, and I personally of the opinion that the outlook is positive for the spinning industry.
So spinners are getting the command back on the spreads because of utilization levels and other three reasons that you mentioned earlier. Is that understanding correct?
Gradually things are improving, yes. Gradually things are improving. Of course, the first benefit will be coming to those people who are quality producers like us, where we have a very focused approach towards the customer, and the people who delivers on a consistent quality, they will get the first preference. And subsequently, obviously, when the demand picks up, the other people also get that benefit of it.
Okay. So do you also do blended yarn, polyester cotton, polyester viscose?
Yes, Prerna, we do that. We have a variety of the baskets. We produce from open end to we produce even air-jet spinning. We produce fine quality from even including 120 count from a premium product. We produce Australian cotton. We produce Giza cotton. We produce knitting. We produce weaving. We produce synthetic. Also in synthetic, we have three establishments. Almost 40%, more than 40% of the capacity is on the synthetic side, where we produce many modal, many kinds of products, a variety of products. And particularly in the synthetic side, so we have a vast number of blended CP, modal, polyester cotton, slub yarn, fancy yarn, which we can call it. There are many varieties.
Okay. So the QCO has been implemented recently, maybe from last quarter, October only. So could you help us understand, will it have any impact on the product volumes or margins, and where are we in that journey, and how much percentage of our production will be benefiting or not benefiting from that movement?
Sorry, Prerna, can you repeat what you said? Which policy you are talking about?
The QCO, quality control order, has been implemented by the government on polyester yarn, so it would be applicable for blended yarns as well, no? Where polyester content is higher than 50%. So just wanted to check on that as well. Will it help us or not?
This will definitely help us in a big way, Prerna.
Okay. How much percentage of our revenue would be those products? And have we seen margin or volumes improving on those products?
So ultimately, this will take some time, Prerna, to kind of to get the margin expansion on that. But and we don't see that segment-wise, we don't see.
Okay. Okay. Understood. Okay. And one more question from my end. Indian cotton prices currently are beneficial, are at a discount to international prices. Do you think the scenario is changing anytime because of any reason?
Like I said, Prerna, just now that what we see, of course, as you rightly said, Indian cottons are, and generally Indian cottons should be all in a discount level because of, if you compare this cotton with the American cotton or the Australian cotton, because of contamination, because of the other properties, probably, particularly contamination is a very, very big factor. So some discounts should be there. And my understanding is that the cotton prices after June probably should be on upward trend, and maybe this gap can narrow down.
Okay. Okay. Understood. And
Hello, ma'am.
last
Sorry to
question.
interrupt, ma'am.
Yeah.
There are several participants are waiting for their questions. Can you please come to the queue?
Sure. Thank you. No problem.
Our next question, ladies and gentlemen, please limit your question to 2 per participant. Should have a follow-up question, we request you to rejoin the queue. Our next question is from the line of Jitesh Gupta from Jain Capital. Please go ahead. Hello. Your voice is not clear. Hello.
अच्छा तो उसका फिर एवरेज बेड का रेवेन्यू कम हो सकता है। अच्छा हाँ गवर्नमेंट के रेट
No, Mr. Gupta, your voice is absolutely not clear. So please, can you?
Yes, sir. Our next question is from Akshay Kothari from GHP. Please go ahead.
Yeah, thanks for the opportunity. So one thing I could not understand is, say for 40,000 spindles, if we do 300 crores of revenue, for the existing 185,000 spindles, because 40,000 got operationalized only in October, our revenue should be around 1,200-1,300 crores. So what am I missing in that?
The 2 things, Akshay, you are missing in that is that one is that every spindle does not produce the same revenue because of the count which you produce. With the same 20,000 spindle, I can have a revenue of 200 crores also, and I can have a revenue of 100 crores also. So depending upon what count, like take an example, if I produce from the same spindle 100 count, my production will be much lower in terms of the value, and therefore the revenue per spindle will go down. Of course, the margin will be different. So you can't simply calculate like that, and okay, 40,000 spindle, you have a 300 crores, so therefore 225. Because it depends on which count you produce, what are we producing fine count, are we producing coarse count. Because same thing, if you compare with the competition, you'll find that some competition with a 1 lakh spindle, that revenue could be something around 1,000 crores.
Yeah.
100,000 spindle. Because that coarser count, like northern mills, if you look at, they're all on the coarser count. 20, 16, 18, 24s. There the revenues are per spindles are very, very high. And therefore, our first objective always is when we say, like I said in the earlier question also, we look at the spread. And our norm is value addition per ring frame. We call it as it. Our focus is always on the decision making is on the value addition per ring frame. Because that's a limitation factor in the entire thing.
Okay. So secondly, what is the currently ROE and ROC we are trading at?
See, generally, like you rightly said, Akshay, our ROC is slightly on the lower side, it's around 11%. And that is where we are looking for it now. Like I said, in terms of your cotton planning, and broadly it is around 11%. Our plan is to take it to around 14%.
Okay. And sir, one of the companies is Ambika Cotton Mills, which actually commands margin north of 17-18%, which you are also guiding for. Now, one thing which I have observed in that company is they actually don't sell at a very lower cost. Even if if the market conditions are not conducive, they will hold on to inventory. So in that case, their working capital cycle actually goes up. So, do we also do such kind of thing wherein we would command our price, and if the price we don't get, we won't be selling?
No, we don't do that. See, every company has a different philosophy, okay? Like you rightly said, Ambika has a different philosophy. They are present in a particular segment. They are present only in a kind of a knitting segment, whereas our product baskets are much wider. And in terms of the size also, our size is much bigger than them. They have around 125 kind of a spindle, if my memory is correct. But yes, they are on a platform, and where our vision, which we are working on that, and to some extent, I said value-added segment. They are in that segment where they have a pull factor into their product.
Yes.
So yes, we will be looking at to come closer to those people. And obviously, in our case, the margin will be more because other costs of ours, like your power and things like that, will be better. So probably, I think our dream definitely is to come to that level what the Ambika is in terms of the quality. But we, as a policy, we are not holding the material and not sell that product. We don't do that.
Okay, understood. Thanks a lot and all the best, sir. Thanks a lot.
Thank you. Our next question is from the line of Mangesh Kulkarni from Envins Financial Service. Please go ahead.
Thank you for giving me an opportunity, sir. Just more clarification on our current capacities as well as means post this 40,000 capacity started. What is the current capacity? And then 25,000 when during FY25 when we are expecting? And also, is it this part of this Tamil Nadu MOU or it is separate?
See, in terms of the last question, this is a part of Tamil Nadu MOU, this 1,035 what I've said. And second 25,000 spindle will be coming in March 25.
Okay.
The third is that, like I said, next year, 24-25, our top line should be around 13 to 14 crores.
Okay. So our current capacity is 225,000, not 265, right?
225, right, including 40,000.
Yeah. Okay. Understood, sir. Thank you.
The next question is from the line of Jitesh Gandhi from Discovery Channel. Please go ahead.
Hi, sir. Just a quick question. Given effectively, is structurally ROC is that you're seeing a 14-15% in a normalized state, the way to choose up ROEs would be to, increase the leverage effectively. And yet we continue to be debt-free now. And I know it's a good thing that we will reduce all our debt despite all of the renewable energy investments, etc. But isn't there some way to either increase our renewable energy investments or increase capacity, or then alternatively give up returns some amount of capital, just so that we can have a normalized amount of debt on the books so that our ROEs are high?
No, you are right, Mr. Gandhi. That completely agree with you, and that is where the journey now we are going ahead on that journey. You will see a kind of a growth path in this business going forward. And surely your concern is very right. And leveraging to up to an optimum level will be important in this. And that's the reason you have seen that we are talking about 1,000 crore of investment. And so therefore we have to kind of bring that return on equity to that level. So far as the green assets you are concerned, yes, in the green assets, when you see the return on equity is slightly on the lower side. However, the biggest advantage which we get from the green energy, and I'm seeing a little bit of a longer term, this will definitely give us a much bigger opportunity with the customers' engagement. Because the way the global customers, now we are talking about the nomination with the best brand. And that will, where one of the criteria is how efficiently you are using the energy or what kind of a portfolio of energy you have. So that will definitely give us a kind of a advantage. Second is your cost of energy gets stabilized for next 15-20 years. I think keeping that into mind, a blend of growth and blend of priority on the customer side, I think our focus will be to achieve that margin of around 14% on a return on equity.
Got it. Understood, sir. All right, that's all from me. Thank you.
Ladies and gentlemen, a reminder, please limit your question to one per participant. Should have a follow-up question, we request you to rejoin the queue. Our next question is from the line of Amit Ketan from Liberum Capital. Please go ahead.
Hi, thank you for taking my question. So first, so you talked about increasing the export contribution. Just wanted to understand what implications does that have on both margins and working capital?
See, basically, Amit, if you look at in terms of the export allocation, why we are doing it, because the two reasons. We want to have a wider presence, that is number one, so that the dependability on one particular market is kind of reduced. That's number one. The second, obviously, in that market, you will have the premium product. See, out of the portfolio basket like a Pima or Giza, those kind of a premium product or Australian, there the demands of those products are better in the overseas market. Of course, in India also there are premium customers are there, but I think expanding the basket, I would not call it that the margins are much significantly better in the export market. I would not say that. I would say it is more of a wider customer base, wider penetration, wider diversity onto the customer base is the prime objective of export. Our focus is on the synthetic side. Is also, see, this volume increase which we are talking about from 14% to 20%, our focus is more towards the synthetic fiber. Because synthetic fiber of this 40,000 spindles which we have come in, they are high quality synthetic yarn. Okay, and that yarn we are trying to penetrate into the export market, where definitely we will have a slightly better margin. I hope I'm been able to answer your question.
Yes. And lastly, we made an investment of 66 crore this year in CapEx, and you guided to another 10 to 15 crore in the last quarter. Given that we've been expensing maintenance CapEx, can you just say what this 80 crores of CapEx is for? Is it for capacity expansion that we've already undertaken, or is it for the green power, additions?
So basically, I mean, what has happened in this is two things. One, like I said, in two of the units, we have done the debottlenecking. Okay. In the existing plant, in the two locations, we have done the debottlenecking to increase the volume in that. The primary, this money has gone into that, and some amount has gone for the infrastructure.
Great. And I must tell you that the presentation is very, very detailed and very good disclosure. I hope that will continue going forward.
Thank you, Amit.
Our next question is from the line of Sarvesh Gupta from XML Capital. Please go ahead. Hello, Sarvesh Gupta. Hello, sir. Ladies and gentlemen, that was the last question for the day. I now hand the conference over to management for the closing comments.
Thank you very much for all the investors. Like I've always been, of course, this call for the textile is the first time. But I just wanted to highlight a couple of things at the end, just to make my point clear. One, our journey from 2001 to 2023 has been really exciting because we had an EBITDA growth of 31%, CAGR growth of 31%, which is not a small amount. You can imagine that 31% over a period of 21 or 22 years. Of course, the volatility in between was there. We have very judiciously invested the money in cost competitiveness, quality product, and expanding the volume in a very responsible manner in this, and created a very focus of enhancing our basket of the product. Like I just now said, that we have a portfolio of synthetic fiber, we have a portfolio of double yarn, we have a portfolio of open end, we have a portfolio of cotton yarn, which is also very wide, from 24 to 120. And in last 4 years, we have started focusing more on quality, penetrating into the quality customer, focus on the serviceability to the customer, understanding the need of the customer, and trying to service them on a unique position so that there is a kind of they're a repeat and they consider as a more of a strategic customer. Team is working on creating a nomination from the various prime brands because there the consistency of the quality is required. So journey has been very exciting, and we will continue to have this journey. Our focus in this business will be growth, like Mr. Gandhi said. Our focus will be to create a platform of a size of this business with a right mix of spinning and the value added of the weaving and knitting, including the ultimately going into the processed fabric. Maybe once we are successful in this model, then we will look at beyond that. But right now, our dream is to that extent. Our carbon footprint or our cost competitiveness will remain always a focus. In one line, if I can say, we will be relevant to the customer with a cost competitiveness and a quality product on a consistent basis, so that they are the customer for repeat and repeat and repeat for a longer period of time with us. I think with this objective, we will grow this business, and we will definitely achieve our target of 17 to 20% EBITDA margin with a return on capital or return on equity of 20%, 14%.
Thank
this
you.
work. Thank you very much.
Thank you. On behalf of Go India Advisors, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.